A very good morning, all, and thank you for taking your time to join us today. We are delighted to welcome you to our Analyst Day meet and sincerely appreciate your continued support to us. The agenda will begin with presentation by management, followed by an open house Q&A session. Thereafter, we have arranged an informal interaction with our business heads and management of the bank. We have also set up kiosks wherein we have displayed some of our major products, features, LOS journey, and customer onboarding features. You may go through them in details later. And to begin the day, may I request our MD and CEO, Mr. P.N. Vasudevan, to start the presentation from strategy of the bank. Thank you, and over to you, sir.
Hi, good morning to all of you. And thank you so much for taking your time out to come for this meeting. We have been interacting with all of you over the last so many years, but in bits and pieces. So we thought we'll take this day out to try and give you a comprehensive picture of Equitas, what we are doing, and what's our focus, and where do we position ourselves, and where do we see ourselves going forward. So we thought we'll just take you through and present a comprehensive view of Equitas. So that's the purpose of today's meeting. So we start off, in Chennai, RBI has got an institute called RBI Staff College in Chennai, where they do training for all their officers. So frequently they get their officers down to Chennai, and as part of the training, they want to give them exposure on financial inclusion. And I'm the one they generally call up to take that session on financial inclusion for their officers. Okay. So I actually have got a few slides here, which I use in those sessions for the RBI staff. The slides I use, I've got a few of them here. And so we'll just start off with that. So I'm going to use the same opening theme that I use in that RBI Staff College. I'll use it here. So I'll start off by asking you a question first. And I do hope that some of you will be more responsive to what I ask. Have you guys heard of the word polio? Polio? You heard. Okay. So when is the last time you remember reading an article or reading about a conference conducted by the government to address the problem of polio? When is the last time you heard of a conference that the government has kind of conducted to address the problem of polio? Long time back, right? Rarely, we are not even able to recollect, correct? Okay, have you guys heard of the word financial inclusion? Of course, yes, right? We hear of the word financial inclusion, we see it. Actually, all of us see it because we see it in our own homes, right? Our own homes, our maids, our drivers, our assistants, our people who help us at home, we see that and we know that financial inclusion is really still far, far away from in the country. Okay. And do we hear of the word financial inclusion, the need for financial inclusion, the importance of financial inclusion? Do we hear that from people like the finance minister, the governor of RBI, etc.? We do. So the word polio, we rarely hear, and the steps to combat polio, we rarely see, because polio has been eradicated a long time back. It's behind us. But financial inclusion is something right in front of us all the time. And that is why even today, when you have a finance minister or an RBI governor standing up in a conference, very rarely they end up speech without referring to the need for improving financial inclusion, right? And this is after 75 years of independence and 60 odd years of bank nationalization, right? So over so many years, RBI and the government of India have taken so many steps to improve financial inclusion. Like what I have listed out here, they've taken a really large number of steps to improve financial inclusion. And yet, after all of this, this continues to remain a major challenge. Why so? We'll just figure out why is it so difficult. Because there's a lot of challenges in financial inclusion. It's not easy. It's not easy. There's too many challenges, and that is why it continues to remain unaddressed significantly by most of the players in the market. I've just given here, I'm not going to go through it line by line, but there's a lot of challenges, be it credit appraisal, be it operational controls, be it collection controls, the entire gamut of handling the clients. There's a lot of challenges which traditional banks are not really, exposed to. They don't have the ability to meet these challenges, and so financial inclusion remains a serious concern still in the country. I myself have been in financial inclusion space practically all my life. All my life. Some of you may not know, but I used to work in Chola a long time back. I worked there for about 20 years, and I was the one who started vehicle finance in Chola in 91. When we wanted to do vehicle finance, I was the one who started that, and I ran it for about 15 years. And even in Chola, though we didn't know the word financial inclusion in those days, but that's exactly what we were doing there. We were, Chola was the first company in the country to start financing light commercial vehicles, right? In 91, we started funding light commercial vehicles. We were the first company in the country. There's nobody else who was financing LCVs in those days. And we had vehicles like DCM Toyota, Alvin Nissan, Eicher Mitsubishi, and Suraj Mazda. These are the four vehicles which was there in those days. And even today, Chola continues to be the market leader in LCV financing. And when three-wheeler goods carriers were introduced in the country in the late 90s by Piaggio and Bajaj Tempo, which is now called Force Motor, when they introduced three-wheeler goods carriers, again Chola was the first company to start financing three-wheelers. And today, I think they continue to be the market leader in that segment also. And, when I travel, in those days when I used to travel to branches and all that, I was always very keen to meet the clients, actual users of the vehicles, and you get a lot of insights of what drives them, what motivates them to buy a vehicle in the first place, and how is their financials in terms of meeting their expense-income gaps. And so I have personally been in this space all my life. And I can tell you, it's quite exhausting. It's seriously exhausting, right? So it's got to be in your blood. It's got to be in your DNA. If you really want to do this, it's got to be in your DNA and your blood. And then slowly from your blood, it has to get transfused to the blood of the organization. And a large number of people in the organization should have the same type of blood group where the financial inclusion desire runs strong, because only then you can manage it. Otherwise, it's so difficult to manage that you want to give up at some point in time. Okay. So we keep saying inclusion, exclusion, inclusion, exclusion. So why is it such a big focus area for the government? So what is the size of this problem that we are talking of? We'll just see what's the size of the problem. I don't want to get into the details of all the studies which are available. It's all available publicly. We have given some references. You can also go back and at your leisure check through these references. But the estimate is that something like 84 lakh crores is the unmet credit demand from this segment of people in the country. 84 lakh crores. And if you compare that with the total banking credit outstanding in the country, the entire banking credit outstanding in the country, around 2.5 lakh crores, maybe 2.3 lakh crores, 2.4 lakh crores, somewhere in that range. So 2.5 lakh crores is the total credit of banking credit in the country, and this is 84 lakh crores. So this is almost like 35 to 40% of the entire banking credit in the country, right? So that's the size of the problem that we are looking at, and which means that if this is the size of the problem, then you step out of your house or step out of your office and go anywhere in the country and meet anybody, the probability of you finding a person who desperately needs a financial inclusion and not getting it is something like 1 in 1/3. Every third person needs it badly, right? So that is the size of this problem that we are really talking about. And so came one more initiative from the government and RBI called small finance banks. And if you read the preamble of the small finance bank guidelines, and if you read the finance minister's budget speech of 2012 by Mr. Arun Jaitley. There he expounds the need for improving financial inclusion and then goes on to say that RBI will come out shortly with guidelines for creating differentiated banking licenses to promote financial inclusion. So that's the genesis of SFB, following which RBI came with this guideline. So the SFB has been created as a concept largely to promote financial inclusion in the country. So, if that be so, then what is the opportunity for SFBs in terms of financial inclusion and their own growth? So, if that 84 lakh crores, which is the unmet credit demand that I spoke about, even if you assume that half of that, which is around 40 lakh crores, either it will not be possible to service at all because the clients are located in a place or whatever it is, they can't be serviced at all. Or maybe some NBOCs who are in that space end up servicing them, and half the people don't get serviced or serviced by NBOCs and leaving the remaining, which is serviceable by the small finance banks. Then you are talking of something like if the demand grows by 10% and if SFBs grow by 20% annually, you're really looking at something like a 30-year time frame before the unmet credit demand can actually be met by the banks, right? So you are really looking at something like a 30-year runway of 20% CAGR to meet this unmet credit demand. And remember, I am only talking of commercial, credit requirement of these borrowers. Where is their personal credit requirements? They also have aspirations. They have a need for education loans. They have a need for health loan, medical loans. They have a need for consumption loans, two-wheeler loans. I'm not even including any of that. This is just from the business loans and affordable housing purpose only. So you're really looking at a very long runway of growth possibility for SFBs, right? Now, I'll just give you one more small dimension of the impossibility of doing financial inclusion by the traditional banks. Impossibility. So, we've given some data, which is all publicly available data. We just classified into large, medium, and Equitas. So, you can see on the right-hand side, I've given a analysis. If the regular banks, traditional banks, if they want to do 10% of their total credit in the inclusion space, right? If a bank has got, let's say, 5 lakh crores of book, if they want to do 50,000 crores from the inclusion space, right? Not even a large part, just 10% of their book, if they want to do in financial inclusion space, then those banks need to employ 60% more people than what they have today, right? 60% more people they need to employ. And are they ready to do that? Will they be able to do that? Will they want to do that? Do they really, will they desire to do it? It's a headache, and it's a big headache for just a 10% improvement in your loan outstanding. And this is a different dimension to the challenge of financial inclusion that we spoke about. So the world of financial inclusion is seriously different from that of traditional banks in the country. And if that be so, then if SFBs are an instrument which is best aligned to promote financial inclusion, then what is the SWOT analysis? Well, I have given that here. By and large, I mean, within the SFBs, there is always going to be a difference between player A and player B, but I'm just kind of saying from a more generic perspective, the strengths of SFBs is always on the lending side because all of us are from the inclusion lending space. So lending is clearly our strength. Weakness clearly is a deposit. Creating a deposit franchise is a big challenge because we are new players. We are now maybe 8 years, 10 years old, but then 8, 10 years may look good, but we are comparing with banks which are either 25, 30, 40 years or 100 years old. So, 10 years is still like a newbie on the space. So our brand recall, brand reputation, and the fact that we are called a small finance. So the confusion in the mind of a normal depositor as to whether you are really a bank, who are you? And finally, when we convince them that I am also a bank and I can't take a deposit from you, then they say, okay, fine, if you're also a bank, but you are something different, so then you have to pay me a higher rate of interest. Otherwise, why should I come to you? So compulsorily, the higher rate of interest becomes a prerequisite. So clearly the weakness is creating a very strong franchise on the deposit side is a weakness for the SOBs in general. Opportunities are unlimited from the inclusion space, which we just saw, and threat. Threat is basically that a large part of our customers might be from the low income segment, which is typically a fragile segment as well as typically a politically sensitive space. And so the larger exposures you have, for example, in microfinance, which is typically addressing the low end of the income strata, the threat can also be high in terms of event risk related issues. So that's generally the SWOT analysis of SOBs. As far as Equitas is concerned, I think we are practically in the same boat on the first three strengths, weakness and opportunity. I believe we are probably very similar to an average SOB. Threat is probably where we are slightly different because over time consciously we have reduced our exposure on MFI, and today the issue of an event-based risk in MFI may not affect us as much as what it affected us even as late as last year. Okay, so threat is probably where we have slightly moved away from the typical industry level threats. And we have got a very large range of lending products in the bank, and most of them, as you can see, have been with us for a long time. And I think we have a very strong bouquet of loan products today, and we don't have a plan to introduce any new product, which means that the further investments and the loss period for introducing new products is behind us. And hopefully we can grow sustainably on the platform that we have created so far. And all of this leads us to towards our strategic positioning. What's our strategic positioning? We want to be high on scalability. So which means your base should be very strong. For you to scale, it can't be narrow, then it can potentially fall. Then the cost of funds is always going to be a crucial factor in making you, strong from a competitive perspective. So we have given you something called the landed cost of funds. We define internally the landed cost of funds as the cost of interest cost plus the entire liability team cost, team, people, infra, the entire cost of liability plus treasury cost plus the negative carry of our SLR, CRR investments, the statutory investments. So all of that cost we put together minus the fee income that we derive from those businesses divided by deposits. That gives us the actual cost at which we are generating the money in the bank. So interest cost is only one element of my cost. There are so many other costs I incur in generating the deposit. So that landed cost of money when we became a bank in 2016-17, that landed cost was 12.7%. Last year it has come all the way down to 8.2%. At 8.2% of landed cost, we probably are in line with a typical good AA rated NBOC probably will be borrowing at those kind of levels today. The challenge for us is how do we move it further over the next 2-year, 3-year, 4-year time frame to a level which is lower than even the best of AAA rated NBOC's cost of funds. So our landed cost of money over time, we expect it to keep going further down and closer to that of maybe a mid-sized bank and far less than any NBOC in the market. And if that happens, and as that happens, the positioning of Equitas will keep getting strengthened, which is basically that we want to and we should be the banker of choice for the entire informal and semi-formal segment of customers in the country. So we should be the banker of choice. We should be the first banker of choice for all these people, be it loans, principally the loans, because that's where they come. And once they come for loans, then anything else related to banking services which they need, we should be the banker of choice for the entire maybe 400, 500 million people who are all in the inclusion space in the country. So that is the positioning that we have been working on over the last 10 years of converting into a bank. And we believe that most of the headwinds of having converted into a bank, most of the headwinds we believe are behind us, as you can see here. The liabilities, setting up the cost structures, compliance cost, which is very huge for a bank, that's all behind us. The small finance concept acceptance by the depositors over the last 7-10 years, we have been at it. And I think mostly now people are accepting that, yes, we are also a bank. And investments in setting up multiple products, both on asset and liability side. On the liability also, we now have a full bouquet of range of products. Besides the traditional CASA and TD products, we have the POS machines, and we have the QR codes, we have the sound boxes, we have the ASBA products in place, we have the 3-in-1 DMAT trading account, we have that in place, we have the gold loans in place. So the entire possible products that are deposited ones, that also we have created over a period of time, investment products, insurance products, and lastly, the only missing link was credit card. So we finally ended up launching that last year. So the cost of starting a credit card division, the entire cost has been put in place last year. And so practically we have now got a complete range of services and products for a deposited customer also, just as much as for borrower customers. And so we believe that the entire headwind of converting into a bank and getting the benefit of conversion into a bank, we believe that is behind us. And now I believe that we are in a position to ride on the tailwinds which are available to us, which is that basically we are a bank. And being a bank, you can really scale it up because we are so tightly regulated, so tightly monitored, so tightly controlled. I mean, I'm sure all of you know it, but RBI has got this concept of SSM for banks, right? So for each bank, they have created an SSM team in their supervisory division. And Equitas, we have an SSM with a team of some 4 members or 5-member team. And their entire job is only to monitor Equitas, right? We are so tightly regulated. In fact, I keep telling my SSM that, when I have a doubt about anything in Equitas, I come and ask her. She knows more about Equitas than me. So we are so highly regulated by RBI. And that is very good. It's difficult to get into the discipline of being monitored so tightly and closely, but once you are kind of overcome that and you put your house in order, that actually becomes a big strength, because now you know that you can really scale up and there's no concern because of scaling up from anybody, because you are so highly regulated. And product platforms are highly diversified. And very critically, microfinance over the last years, when we became a bank in 2016, 17, our MFI was 53% of the total book. Today, we have over time brought it down to 10%. Even last year, when the MFI crisis hit us, we were at 20% of MFI book. And that's why the impact was very high for us last year. But now we have brought it down to 10%. So we believe that at 10%, we can get the benefit of the better yielding MFI book when the times are good, and when the times are bad, and there is going to be a higher credit cost, it may still not too significantly impact the bank. So we believe that 10% is a reasonable level, and our aim will be to keep it around that level. And landed cost of money, as I said, should keep coming down over the next 2-3 years. And given the size of the unmet credit demand, so we believe that we have a lot of tailwinds to ride on, and most of the headwinds we believe are behind us. And the final slide, this is where the customer segments which Equitas focuses on. A few years back, we were largely in the informal and very little in the semi-formal. Today, we are largely in the informal and significantly in the semi-formal. We are practically at all levels of semi-formal part of the economy. And over the next 2-3 years, 4 years, as our landed cost of money keeps going down and we keep moving up the value chain of the borrowers, then we will get into the lower end of the formal segment also, which will not only spur growth but also improve the stability of the portfolio. So while we will still not be vacating the informal space, because that's our strength and that's our DNA, that's our core strength, so we are not going to be vacating that, but we should be inching upwards on the top end of the customer segment also to improve scalability as well as stability of the book. So that's where we are as a bank now. And what we believe is that over the next 2-3 years, we believe that we should be able to take this bank sustainably forward, profitable growth, and sustainable growth. The only challenge that I see There are two challenges, of course. One is on the deposit side. I told you that, that's a weak area for SOBs in general and definitely for us also. We are trying to overcome that always by giving a little bit of an extra interest rate, but over time we'll keep reducing that to improve our cost of funds. But that will remain a challenge for some more time till our brand recall improves over a period of time. And maybe at some point the small finance tag at some point we can drop at some point in time. That may also help. But that will remain an area of focus for us going forward. But if we are not too concerned about that, because at the end of the day, given our strength on the lending side, we can always manage a 10, 15, 20 basis points increase in cost of funds can be comfortably managed and absorbed by the bank. So while we may have to pay more from time to time, it may not be a major issue in terms of our ability to absorb. The real challenge and the real focus and the real challenge for Equitas, which can support or disrupt our growth, is our own internal capability. I think finally it comes only to that, our ability to manage. Market demand is not an issue. The bank's stable platform is not an issue. The wide range of product platforms on both lending and liability side is not an issue. Highly regulated industry, that's also not an issue. And customers are never an issue. Then what is a possible issue? The only possible issue is execution. I think that is the only possible issue. If we execute well, I think we are on track to create a very sustainable, profitable, scalable bank. If we falter in our execution, yes, of course, then the story is not going to be bright. Okay. So I'll just end this with, again, going back to my Chola days, I'll just end it by saying that in the 90s, a multitude of NBOCs had cropped up in the country, multitude of NBOCs. I don't know, some of you may be aware. Alpic Finance, Apple Finance, Mango Finance, all kind of finance companies had cropped up all over the country. All of them died. All of them folded out. All of them folded out. Only a very few NBOCs survived. Which are those NBOCs? Sundaram Finance, Ashok Leyland Finance, Tata Motor Finance, Mahindra Finance, Shriram Finance, and Chola. Only 5-6 NBOCs actually survived. And if you look at this 5-6 NBOCs, all of them had a natural advantage. Ashok Leyland Finance, manufacturer. Sundaram Finance, distributor. Tata Finance, manufacturer. Mahindra Finance, manufacturer. Chola Finance, nothing. In Chola, when we were there, we had no natural advantage. So, the right to win, as an analyst or investor, the question that you keep asking companies, what's your right to win? What was Chola's right to win? It had nothing, because everyone else had one big natural, advantage, which we didn't have. So what was the right to win for Chola? The right to win for Chola was only built on two factors: innovation and execution. It was just built on these two. We had to be highly innovative, so that's why we were the first on this and first on that and all kind of stuff. So we always took that extra risk because we had to be innovative. And execution. Solid execution had to be the prime focus of the company, because that's the only way you can sustain and grow. So that is how we used to operate there. And I think here we are again sitting on the same position or picture today, that we just need high quality execution. I think everything else has fallen in place. Everything is in place. We just need high quality execution. And if we can do that, then we'll have a good story as we move forward. If we falter, then of course, you should ditch us, right? But I hope that as a team, starting from me down, as a team, we will be able to execute well. We have always took a pride in ourselves in terms of our execution. And that's something that we should be able to handle going forward. And with that, I believe that we have some good, picture coming up forward. And let's see whether we are able to deliver it to all satisfaction, to everybody's satisfaction. The last point I'll just touch very briefly is on governance. I don't have a slide on that because I wanted to just actually I was thinking, I'll put one slide, governance as heading, and Equitas in the middle of that page. That's it, no explanation, just no explanation. Equitas governance. I think everybody knows, all of you, I hope, know that we stand on the highest levels of governance in the entire banking industry. I mean, I keep telling RBI, I go to RBI office and I tell them that we are probably the bank with the highest standards of governance in the country. I go and tell them in RBI because I want somebody to challenge me. I want somebody to tell me that, no, that bank is doing this, you are not doing that. That's much better governance standards than yours. I want people to challenge me because if they challenge me, then it's a learning for me, and then we'll go back and improve on that area also, whatever be that area. But otherwise, if nobody is challenging me, then I believe we definitely are the best in terms of governance standards. We leave no stone unturned, and the word equitas is a Latin word, which means equitable, which means being fair and transparent. So everything that we do in Equitas has to be compulsorily, completely fair and totally transparent to all our stakeholders. No one should get a surprise from us, from any source other than ourselves. If we have a shock or a surprise in store for any of you, we will be the first to come and tell you. You will not hear it from anywhere else. Similarly to RBI also, our pitch is the same thing. If there is anything bad to be heard about Equitas, you will hear it from us and not from anybody else. So we are very strong on governance, and anyway, that's something that's now part of the DNA of the bank. So with that, I come to the end of my presentation. Thank you so much for hearing me out. I think Q&A is at the end of the sessions. So we'll wait for the Q&A. Now I'll request my colleague Jaggi to come forward. Thank you.
Thank you, sir. Good morning, everyone. Let me start with a perspective on how we built our asset franchisee. Our portfolio today reflects a very conscious and disciplined strategy. We have built a highly diversified book, of which 88% being a secured book. This provides a foundation from the risk standpoint and also enables to generate attractive yields. The more important is how we serve our customers. It's rather a one-size-fits-all approach, but we have developed the product offerings tailored to distinct customer segment within the semi-formal and informal economies. For instance, in small business loans, we cater to micro enterprises, small business owners and services, these segments are not formally being underserved by the formal credit channels. Same way in the vehicle finance, we cater to the driver cum owners, supporting their livelihood and income generation. On the housing finance side, we cater to the first-time home buyers. So when you look at our portfolio, we are not diversified only on the products. We are diversified across the customer segment and economic activities. That's what our portfolio builds both on resilience and depth. On our portfolio performance, talking about the yields. If you look at our Q4 financial year 26, our overall yields at 15.665, excluding the direct assignment book. And our non-MFI yields at close to 15%. More than just the number, you look at the consistency. The yields have been within the narrow band for the past several quarters. The stability is what we build in this book. This is basically a combination of a diversified product mix combined with the secured portfolio, which allows us to balance our growth, risk and returns in a calibrated manner. Let me talk about our distribution network and growth approach. When we transitioned the bank, at that point of time, our asset branches are 528, and currently we stand at 630. In the past 9 years, despite a modest expansion in branch network, we have achieved 23% CAGR on the overall advances, and more impressively, 30% CAGR on the non-MFI advances. This clearly indicates that growth doesn't been driven by the adding number of branches. This has been done by improving the productivity and deepening our presence in the existing geographies. And one important aspect is, in 2017, our TN concentration is close to 55%. Now it stands at 45%. This is primarily our 90% of the branches has been added on the non-TN states. And this is being a work in process. We want to bring down our TN concentration to 35% in a span of 3 to 5 years. One interesting aspect which I would like to point out on our branch network Our 34% of the branches has been classified as urban. But our customer catchment extends up to 25 to 35 kilometers. So our customer catchment normally is semi-urban in nature. Even though we have an operational efficiency of the urban setup, we cater to the under-penetrated markets. This gives us a strong confidence and proper headroom to scale up. And one data point which I like to point out, our per branch average advances in small business loan is only 36 crores. Similarly, as far as the vehicle finance is 38 crores. So we don't have to drive the growth by adding more number of branches. We have enough scope to grow within the existing geographies. Now let us spend some time on our small business loans. This is one of our flagship asset product, and it's the most profitable product segment across cycles. The small business loans, it's an 100% secured product backed by a residence as a collateral. And we offer ticket sizes between 3 lakhs to 50 lakhs with a tenure of 5 to 15 years. But the average ticket size of this product is between 9 to 10 lakhs. We cater to a wide range of semi-formal and informal customers, ranging from micro enterprises in retail and trade, small manufacturers, agri-linked businesses, and essential service providers. And they have been serviced to a range of products like micro lab, agri, BL, G lab, and S lab. This segment of customers have a limited access to formal credit. That's what our underwriting requires, a local and deep understanding of these segments. That's what our in-house credit assessment framework plays a major role, where we assess majorly on the repayment capacity of the borrower, where the collateral only plays a secondary source of comfort. Some of the inherent strengths which I would like to point out in small business loans, it's a diversification within the product. It's very much granular and well spread. We don't depend on one particular borrower profile or loan ticket size. We cater to across customer segment within the informal and semi-formal. That's the inherent strength of this product. And second most important aspect is the asset quality. If you look at the asset quality over the years, it's only 0.6%, where we would do the business with the yields of between 16 to 17%. Why we could be able to maintain that such kind of asset quality? It's because of a robust underwriting and strong collection framework. I will just share you a simple data to exhibit that. We don't do any write-offs in small business loans. Similarly, on the NPA resolution, we don't go for a settlement. One data point which I like to point out, last year, we have resolved close to 7,500 NPA customers, and we collected 103% of the principal outstanding, which clearly indicates we don't waiver our principal in this loan. That's where you don't get much losses in this product. And our sourcing model is a well-balanced. 70% is direct, 30% is connectors, mostly our freelancers. It minimizes the risk of BT because it has been sourced majorly through the direct sourcing model. We don't source through DSA in small business loans. So these are the major strengths, and that's why it became more profitable across cycles, whether it's a demon or GST transition or COVID disruptions. And more importantly, we also seen this type of customer segments come back very strongly, even though any external factor hits them, which we have seen even during the COVID disruptions. In the month of September itself, we can able to see our expected resolution close to 97 to 98%. Even during COVID disruptions, it has been much more profitable. So any external factor hits, it comes back strongly because we cater to the customers who are in the essential services. So this is about the SBL. Now we can go to the vehicle finance. Vehicle finance business enables to skill drivers transition to the owner entrepreneurs. Here we operate on multiple segments like used commercial vehicles, used cars, and new commercial vehicles. Each segment catered to a different borrower profiles and income pattern. Again, here we have a diversification of customer profiles. Our major focus is on the used commercial vehicle and used car, which is growing at close to 20% upwards in the past few years. Whereas on the new commercial vehicles, we have been focused selectively on our financing. So the de-emphasis on the new CV have an impact on the overall trajectory of the VF book, at least for this year. And one inherent strength in vehicle finance is our geographical spread. Our portfolio built over the years, it's not dependent on any single geography. It has been diversified across multiple states. That's one of the inherent strengths. And again, the sourcing model is well balanced. It ranges from direct, connectors, and dealers, which enables to scale up efficiently. Now we can talk about the housing finance. Housing finance, we cater to the first-time home buyers, majorly on the lower and middle-income customers, primarily skewed to the self-employed profiles we cater. And the portfolio is diversified again here on the self-construction, home purchase, and loan against property, which provides a diversification in terms of the end use and the borrower profile. Housing finance, if you look at our CAGR, it's growing at close to 46%. It's an high growth engine for us. And look at the asset quality, it has been only 0.4. It's an high quality asset product for us. Again, here we have a significant headroom to scale up, which we will be doing it through our presence in the SBL branches. We won't be adding any standalone branches in the housing book. We will be enabling our growth through presence in the SBL branches, which will give us the cost efficiency. And again, since SBL branches is majorly placed in Tier 3 and Tier 4 locations, there is a scope of improvement in yields in the affordable housing going forward. On the MFI book, which has been already covered by our MD, that we used to have 50% of the portfolio during 2017 on MFI, which we consciously brought it down to 10%. This is more of a calibrated transition, more than the reactive one. We want to keep it at these particular levels at 10% because our focus will be more on the secured book. Currently, the microfinance book has been structurally very strong and more disciplined. For instance, you know the guardrails, MFIN guardrails, we should not lend to customers who are in 60 plus DPD. But what we have done, our internal norms, we don't lend to customers who are in 1 plus DPD for new to bank and new to credit customers. Similarly, for existing to bank customer, we don't lend to customers in 30 plus DPD. It really shows our conservative risk approach. Additionally, majority of our portfolio covers under CGFMU, which offers additional risk protection. Our MSE and NBFC portfolio, if you look at our MSE book, it caters to the organized segment of the small businesses. This is primarily a relationship model where our sourcing happens through the liability networks. Similarly, NBFC, it's more of calibrative and selective. We only lend to the AA rated and above institutions. Gold loans will be the focus product for the asset franchisee going forward. Currently, we have built up the portfolio through our liability franchisee. We just added up some 30 branches in the first quarter, which gradually increased over in the next few quarters. By end of this year, we will be having close to 100 to 120 branches operating from the asset franchisee. And finally, on the collection strategy, Our collection framework is mostly a proactive and data-led, where we can able to identify the customer stress by looking at the repayment behavior pattern of the customer, and by constantly engaging with them, improves the resolution not only on the yearly buckets, but right from OD to NPA. That's what the data point which I pointed out. Even customers goes into NPA, they come and resolve. We don't resolve much on by taking their property. So we have a constant engagement across on all buckets, which improves our resolution. In addition to that, since we are covering the semi-formal and informal customer segments, we need to invest a lot of field force to manage our collections. So we have introduced the telecalling setup in 2 centers, in Chennai and Bangalore, where currently our 30% of the field collections have been done through our telecalling setup, and which we want to increase to a level of 50% by adding more centers, more telecalling centers. And the productivity between a telecalling and the field force, it's a 3x, which will optimize the cost in a bigger way. In addition to that, our digital collection has been increased to a level of 60% on the field collections. So to sum it up overall, we build up a highly diversified secured portfolio which generates yields between 15 to 16%, catering to the semi-formal and informal customers. Our approach on the growth will be mostly on the productive-led rather than the branch-led. And we will always look for a profitable growth. Thank you. I will hand it over to Steeman.
Thanks, Jagdish. So, good morning, everyone. So now we are talking about let me briefly walk you through the underwriting framework. See, basically, any credit assessment model revolves around 2 basic aspects, right? One, ability to pay. Second is willingness to pay. These are the 2 things we have to ascertain. Now, but it's as far as a traditional underwriting is concerned, you will all take ITRs, financials, ratio, backing turnover, analysis of key ratios and all. But whereas, and willingness, how do you evaluate? You will look at the credit bureau history, repayment pattern in the bank statements, etc. But whereas, however, coming to Equitas, we are catering to the customers. Since our MD has also covered and Jagdish has also covered, this segment of customers, what we operate as, they do not have any documented source of income. And they have very limited and no access to bank statements, bank channels, and also very limited banking habits. So these customers are prima facie first-time borrowers, with a very limited and no credit history, and their repayment capacity is susceptible to income disruptions like sudden business losses, loss of employment, and majority of these borrowers are depending on the overall household income to service the EMI. So any family dispute or a death of a main income earner or medical emergency in the family adversely impact the repayment pattern. And in addition to this, any natural calamities, like a flood, heavy rains, and the political movements, government regulations, all these are also impacting the repayment habits. So in this above scenario, Equitas stands out building a proprietary, data-driven, time-tested credit underwriting framework, which built upon the deep customer insights and extensive field experience. The testimony to this time-tested model helped the bank to navigate successfully. In fact, Jagdish was also covering this. Major black swan events like demonetization and 2 COVID waves. In the last 13 years, we have developed about strong 30 plus template credit models, which are exhaustive enough to cover every business which in our catchment area. So what are the key features of our credit template? They are highly customized. Second, they evaluate the business cash flows very effectively. Third, these templates evaluate business viability. Then repayment capacity is properly evaluated. Most importantly, they address the challenge of limited income documentation. And this model is designed in-house, basically, through years of grassroots engagement. Then this is a robust credit appraisal model while keeping the broader objective of financial inclusion. And when comparing to the risk governance and process rigor, our risk framework ensures rigorous uniform standards, underwriting standards, supporting the portfolio quality, risk mitigation, and sustained growth. Now let us look at how it operates. Like we have a process and we have a risk mitigation to every process. It is like risk chakravyuha, right? So everywhere we are having a constant engagement that nothing goes wrong. First thing is, these are small ticket loans. When you look at the SPL loans, majority of our portfolio comes in within the 12 to 15 lakhs bracket. So sales team engage with the customer, they do the credit assessment, they will do the PD. But constantly, what credit will be doing, we will do a random sampling of the files. Approximately 20% of the files will be randomly taken. So this ensure that there are no conflict of interest. Second, the accuracy of estimation of business cash flows. This is very, very vital because as the earlier speaker said, it is not depending upon the collateral. It is majorly depending upon the ability to pay or the customer's ability. So any misjudgment can really hamper us. So we have inbuilt auto-factoring decision engines, which is fueled by various decision logics. Say, for example, if I am looking at a business, I will look at the nature of business setup. If it's a proper shop setup or a roadside business or a push cart, so based on that, your factoring will change. Similarly, it's based on business stability. How long he is running this business? How many years he is having the experience of business? Then, whether this business is formally registered or it's an unregistered business. And similarly, what is the seasonality of the business? So these are the aspects. Based on that, our decision engine will automatically calculate what can be the score it can be given and what is the percentage of income we can consider. Second, if you like a cash salary, because I told you in the beginning of the discussion, we take the entire family income. In every loan proposals, say 3 to 4 family members will be coming based on our income ownership metrics. So if it's a cash salary, we are capping at 20,000. We will not go beyond that. And we will allow only maximum 2 applicants. And similarly, if it's a daily wage profile. So we categorize these daily wage profiles to 2, skilled workers and non-skilled workers. Say based on profile like AC mechanic, plumber, electrician. And every profile, we have inbuilt model where we will fix it based on the earlier past experience and industry trends, what can be the maximum income he will be able to derive. And obviously for daily wages income, though 30 days is the calendar days, we'll only consider 15 days income and we'll apply the factoring accordingly. Similarly, rental income. We have cash rentals and bank credits. If it's a cash rental, we will also cap it based on the overall income. And we'll also consider the pension income. So whatever we are doing, the system will do a auto calculation and it will throw out what can be the eligibility for this customer to take it forward. And I haven't told you, we have the credit intelligence team which is taking 20% of the sampling. Whenever they do a sampling, their report comes from the system. It will auto-compare and will say what is the variance between the business CAM and the credit CAM. CAM is credit appraisal memo. And any variance is there, it will throw it immediately so that the course correction actions can be taken immediately. When looking at the collateral, see, all our major portions except MFI book, all are secured books, right? So the collateral of micro properties not really challenging. So what we will do up to 7 lakhs. The collateral valuation is done by the in-house team. That is business team or credit team itself is doing the collateral valuation. Then we have a methodology of doing the valuation. Like for a land valuation, we will go by the government reginate values and we will apply certain times, different 2.5 times or 3 times of the value we will be taking based on the market value. Then identification of the property. This is very, very important. Whatever property we are identifying, we have now the government, different governments has come up with the various apps. Like for Tamil Nadu, it is GIS. And if you say Karnataka, say you have 2D Bhuvan app is there. Haryana cadastral maps are there. See Maharashtra, when you look at Bhunaksha is there. So similarly, everywhere we will identify the property based on the satellite images and the government things. And we also having timestamps showing the geo coordinates to ensure that the property belongs to the customer. And we also have a building valuation depreciation grid, which exactly tell what is the value which we'll be able to give you. And LTV will be calculated. LTV is loan to value ratio will be calculated based on the nature of the property and collateral this. And if There is when I'm assessing an income, the business is assessing, say up to 7 lakhs, we are internally assessing. If any value which is going more than 2.5 times, automatically there is a risk trigger trigger. RPA, we call it as risk property assessment. It will move to the risk queue, and the risk will do an independent assessment, and they will evaluate and certify this is the valuation is correct. And more than 7 lakhs, all valuations are done by the external valuators. So, based on all these parameters, based on the customer profile, based on the income sources, based on the customer demographic details, and based on the collateral, a risk scoring, final risk scoring will emerge. Based on the risk scoring, we'll categorize that as a various risk level, low, medium, and high, and the final underwriting will get completed based on that. So now let us look at some sample assessments. See, we have just showed two things, very easy to understand, a provision store and a tea shop. So when you look at the provision store, normally what we will do, we will generally go there, we will spend considerable time, because this is very important. The field connect is very important. How do you assess the income? Field income is very important. So we will estimate the stocks and its breakups. Then what we will do, what is the turnover, stock turnover rate? We call it as a replenishment period, right? So when there's a rice sack is there, within how much time he will replenishing, within a week, within 10 days, how much time it will take. So that shows the sales, how much sales he is generating, and the profit margins for every product. So we categorize it as spices, staples, pulses, FMCG packed, edible, non-edible, soaps, detergents, etc. And we will apply profit margin for each product. Then based on that, we will generate the daily or month, then extrapolate to monthly income. Then we will minus the monthly expenses, recurring monthly expenses. Then we will consider the monthly income. So every profile, I have told you 30 profiles we have evaluated. Every profile is unique. Completely unique. You should understand the business model. You should understand the nuances of the trade. Only then you can do a better underwriting. That is the key of success. That is a key of success for Equitas. Because last more than a decade, we have the extensive experience in this field. And we also do reference checks. Very important. Reference check is also equally important with the supplier, neighborhoods, customers, and all, to understand that this guy is for a long time. Then ours is completely. Everything is fully automated. Rule-based engines are there. From login to disbursement, it is a full-fledgedly we are doing this. Our eKYC, e-sign adoptions are already crossed more than 95%. So robust as Equitas, we believe, portfolio quality. See, business is very important. Whenever we are getting into any reviews, first thing what we look at is how is the portfolio quality. The review starts from collection, then to business. It is not from business to collection. Right? So that much importance we are giving to the quality of portfolio. For that, underwriting is the backbone. We believe we have a complete robust way of doing credit appraisal. And so thank you all. And I will now request Mr. Murali Vaidyanathan to take you through the liability strategy. Thank you. Thank you, sir.
Good morning. I will start from where Vasu sir left. He said the struggle for SFB or Equitas till we reach a certain threshold is going to be liabilities or deposits. It's because of the very nature of the business. You handle duality as in a day-to-day mode, which means on one side, you have to get money from a overserved segment to cater to the underserved segment. If this is the bridge we have to go through, what sort of a product interfaces, what sort of a user interfaces, what sort of a technology, what sort of a operations we will cover, what sort of a segmentation, because it becomes very critical to put the platform and footnotes and pillars right. So we will start the proposition starting from where we are and what we intend to do. So just to give you all a snapshot, as a division, we are running at 42% CAGR. Last year was slight aberration. I think that we will connect it. And most important part of it is we are granularized at a consumer level or at a retail level. So 68 to 70% of our book at any given point of time, retail CASA, retail TD. And even on bulk, we only go with the philosophy of getting non-callable by nature so that you protect on one side the stability of the book, on the other side, compelling ratios what we need to maintain the governance standard. So close to 88-90% of our bulk TD is non-callable. When you say non-callable, it's fixed tenure. So these two, how it helps in terms of book management is always you maintain a reasonably good LCR. Because in today's game plan, LCR has become a very important thing along with structural liquidity statements. Now we have gone into the next balance sheet, that is rupee and dollar. We are opened up our dollar, euro and GBP balance sheet. When I say that, we have started our AD1 business. When we started our AD1 business, it was only in AD USD. Now we are into 3 currencies. So FCNR has already started coming in, and now we'll see the traction in coming days. Next. Now this is a very important slide. How do we upfronted it? Vasu sir touched in this headwinds and tailwinds section, where he was talking about your cost, your positioning, and your position of branches. So our branch-led strategy is more or less we have optimized, and incrementally we might add maybe 15, 20 branches every year. That's it. But the most important part is the deposits are not coming or skewed from one particular segment or one particular market. This is very interesting slide. If you would have correlated with Jagi's branch matrix and branch business slide, today if you see close to 60 to 63% of the money which is coming from metro, from 30% of the branches, which means where money is there, where consumers are there, we are there at the right point. Do we need slightly more, or how do we need to reach them? We'll cover subsequently. But the most important part is today the money is coming into our system from few critical segments, from few critical markets, which is metro-centric, then backed by urban. So semi-urban and rural put together is 12%. 88% of the book today is from 53% of the branches between metro and urban. So which means overserved customers who have come in for rates and who have started using us and started feeling the convenience of relationship banking, interface banking and technology is stepping up the game. Now, how do we going to do that? I'll cover the next slide. Please go next. This is the range of product. I think for any established private bank or even you can go to the next level and challenge yourself, the entire product suite is here. There is no single product suite which is outside this is available with anyone else. Like in Gita, they say, no, what is available here is only available everywhere. So I think that's a phenomenal development for a bank which has started 7 years back, new into the liability. For example, I'll just take one simple product called ASBA. Today, I think we are one of the very few SFB which has retail, TRV and AIF-based ASBA within the app and within the system. So I think this is a very significant platform. And so name anything what is needed for a liability, wealth management, trader, saver, which means we have moved out of only saver as a community to cater to multiple community. And last one, AD1, which we are talking about is inward, outward and offshore funds to come in, and that's a technology by itself. So what we see here, like Vasu sir mentioned, it is not traditional CASA TD, you give 7%, 8% acquire. It is the total number of cross-sell opportunity and proposition which we have manufactured product, third-party product and in-house technology-centric product. Now, how do we reach these customers? We have banking channel, one sec, back. This is very important. We operate on all 3 modes, physical, digital and phygital. In physical, when we say you have branch, you have relationship manager, and you have specific channel to acquire, and you have specific channel to relationship management and portfolio management. In digital banking, we have mobile, absolutely gone with the latest version, speed, transparency, as well as features. Then we have phone banking, voice over data. Then we have WhatsApp banking on social media where we nudge customer and customer can also interact with us. And then we have virtual RMs whom again for relationship calls, whereas phone banking is only for query resolution. Last is phygital. We have just started this express banking, BOW Banker on Wheel. We have started in 31 locations within that pin code. So few cities, 5 cities to be very precise, where this is going to be next level of service through sales and sales through service, where any person can download the app and place a request. A person will go and fulfill. While he's fulfilling, this is a very important feature for security. It's like any Swiggy or Zepto. You can see which person is coming, and to authenticate that person's entry, OTP is sent. So end to end, this is going to be the future. If it gets right, tomorrow the entire sales channel will be on this banker on wheel. Next. Now segments. Again, we have seen it in Vasu sir's slide. Segment where we cater to mass and mass affluent, we said. We are very focused on mass affluent, where we have branches and resource-led strategy, because our entire proposition of relationship management, branches, product, features, is based on mass affluent as an approach. So we have, how earlier we had to have program, and this is driven by program. This is not a product. So in a program, the biggest advantage is you can add, subtract features, add, subtract value-added services. So this is a very important proposition, and today 60% of the book contributed by 18-20% of the customer is on Elite. So just to give you an example, how we have segregated, Artha is a super premium program for HNI, and we have Elite for mass affluent. For entry level, that is mass to affluent, we have a product called Elite Epic, and these are all loaded with features. It is not only loaded with only price points. Then we have something Elite Epic for NR-based customers. This is an Elite program based on NRI and their requirement. Next. This is how we categorize the segments. It's very important. What happens in offerings? Mass affluent, we are talking about a person who can maintain certain threshold of value in terms of RV, but needs a lot of payments and transaction to be done. So this is a product, and now we have introduced a Elite Lite as a program. Next is HNI program, Elite and Elite Artha. I think there is no, nothing to go around. It can be the best, like Vasu sir said, no, governance and Equitas. I think if you put Artha and put anything else onto that line, I don't think there is any other feature which is, coming closer or inferior to any bank at this point of time. And this we are predominantly targeting for ultra HNI segment in between. And next is non-resident. Today we have non-resident entire suite of products on saving. In terms of investments, we are developing how do we get them PIS. That's the only gap there. I think otherwise inward, outward remittance, FCNR and domestic. NR is full stack completed. And next is business banking. Business banking, which we talk about, is current account, payments and transaction business. Today we have range of products. Today we have range of payments process, whether it's a QR, whether it is a POS, and we have WAN solution. And WAN solution, we can comfortably say we offer one of the best WAN solutions at this point of time. Over and above now, what we have done is we have started focusing on branches to do a cross-sell of assets. So we are launching unsecured product to attract stable current account into the book. So this is the journey by itself on business banking. And digital enables, we have now assisted as well as do-it-yourself. In assisted, I think few of you should try. It can be benchmarked against any bank. I'm not exaggerating. A person come with a mobile or a tab and it is done in 3-4 minutes. We, including authentication to account number generation. And second is do-it-yourself. It's download the app and we are there like any best banks that is available, and we need to scale that up. Sourcing and relationship channel, we have dedicated sales channel which sources, which uses digital modes. So when this is the assisted mode, a person visits your house, fulfills it through digitally and comes back, then customer has the choice to fulfill everything through the app. So our digital onboarding, RM-led engagement, and data-driven cross-sell, which we'll touch in the next slide, and integrated product suite. So product suite, perfect. Relationship model and technology to complement that, perfect. Like our MD said, only the execution of bundling this and getting it is a challenge which we are going through at this phase of time. Next. This is just to show you we have multi-channel. When I say multi-channel, we have sales channel, we have NR as an exclusive channel, we have current account as an exclusive channel, and we have a small team for Insti business. Now these businesses are doing targeted events and activities and backed by data what we giving it. So it's a full stack of independent activity, subbing it into the bank branches at this point of time. So what we are saying is through this approach, we are looking at 50% of Elite book in every branch, or 50% of the sourcing to happen from Elite. 10% will be NR. Today, NR, we are close to 3,500 crores in terms of total book. And we have customers from 175 countries. So that's one quantum leap. Now, how do we leverage, use, and make them get into consuming more and giving reference is going to be the next thing. And 20% is Insti task. Presently, it is at 13-14% levels. And 10% others. When I say others, there will be products because we also are present in semi-urban and rural. And that needs to cater into our overall scheme of things. Next. Now, relationship management, everyone speaks about, I have a dedicated manager. How we are different? First and foremost, we have an integrated CRM model. And as of last month, the usage of that is close to 90%, which means propensity-based customer-related data. What is he going to do next? What is the potential for us to get into the family banking? And what he should act and react? This is properly fed, monitored, system driven. So CRM drives this entire stuff. Now to drive the CRM, we have a full-fledged data analytics engine where Suresh and team also works with us, where we understand the life cycle and we maintain the RV based and product holding. So product holding, RV, and most importantly, family banking is what we use data analytics for. And this is to drive customer value engagement. As I said, only price point is not going to help us. So we have created the suite of products which I showed you. So today for sell and cross-sell is going to be the key objective, and that is driven through data. Business banking, long way to go. We have just started the journey. Today we have payment solution, we have transaction solution, and most importantly, we have cross-sell solution through assets secured and unsecured at the branches. Today, branches contribute close to 20-25% of SME. It can go up. We have just started the secured lending. So through that, as well as unsecured lending, the nearest catchment can be our preferred banking, our business banking partner. So today we have 50% of customers who are active, and 22% of our current account customers use our POS or QR. And that's one significant change in last 6-7 months, which we are seeing. Now, how do we embed this like any other payment or transaction company is the journey all about? Next. As I said, all of you should download this app. Today, we can confidently say on cards, that is plastic side, we have the entire range of Master, Visa, as well as RuPay, and we have the entire range of cards from classic to signature offered on debit, which means full stack available. On app, all transaction, UPI enabled to Bharat Connect, to ASBA, to InsurTech. We have something called InsurTech where you can get a comparative. It's like to our own customers like Policy Bazaar. So you can compare, evaluate, and take the call. And now we are building that NV into the app so that you can actually download and start buying, paying premium, or even put claims through that. And we have something called Invest. It's an integrated mutual fund Dion platform, which not only gives you to buy or sell mutual funds, it also gives which is a performing fund, which is the best performing fund manager for that particular area. So you download an app, it's an encyclopedia of data backed by easiness of operation. I think today it is fast, smooth, and very importantly, light perspective. So with this note, I'll call Balaji to come and explain to you more on digital and operational and technology side of the bank. Thank you.
Good morning, everyone. This is the first time I'm meeting many of you. So just to very briefly introduce myself, my name is Balaji. I came on board about 15 months ago in March 2025. I serve as the ED of the bank, and I functionally look after technology, operations, process, service. Today, what I will talk about briefly over the next few slides is our technology and digital strategy. Technology is the beating heart of a bank today. Collectively, technology, digital, and cyber constitute the single greatest opportunity for a bank and the single greatest challenge for a bank. Opportunity to grow, opportunity to retain customers, opportunity to offer new products springs from our technology, digital, and cyber. But equally, it's a challenge if one can't retain customers or if we can't maintain a safe cyber environment. So these are the themes I'll focus on today. First, as a management team, we sat down some months ago, earlier this year, and we envisioned what will we look like for our entire tech stack by the year 2030. We drew up a 5-year roadmap, which we presented to the board, and these are the key principles underlying the roadmap. A laser-sharp focus on going digital, on improving customer experience and ensuring seamless journeys, on building in-house software and getting away from vendor-driven software. And I'll touch more upon that very important theme. Designing and reusing multiple components across the entire customer lifecycle, across products, automating operational processes to reduce our manual touch points and headcount, and adopting emerging technologies. These are the 6 themes which were the drivers of our roadmap. In the next 2 slides, I'll talk about our digital strategy, which Murli touched upon. Many of you, I hope, will use our new app, 2.0. It was taken live last year. The visuals just show you a little bit of a comparison how we migrated from a fairly old style app to a new, modern, clean, uncluttered interface in the new app, which also covers multiple products. Not entirely 100% yet, we're getting there, but it is a market compatible app at this point. The graph on the right it's a very interesting graph. The blue line is Equitas, the bottom blue line. What this graph shows is how we stack up on digital capabilities. Now, the maximum theoretical score in this benchmarking is 100%. No bank is yet there. But if you look at the three lines on the top, those are private banks, SFBs, and public sector banks. As of last year, as of March 2025, they were significantly ahead of Equitas on digital capabilities. But if you look at the blue line, with the investments we're making in digital through in-house team which has been set up, we are rapidly catching up, almost there in terms of comparisons with other banks. And the convergence point will be reached by end of FY26, where we will be on par with the best in the market on digital capabilities in all sectors. So that's the investment we're making in digital. At the bottom half of the slide, you see some of the features we have brought in. I won't go through each of them, but the fundamental story is we have done a lot already, and we have a full roadmap of what will go live over the next few quarters and into the next year as well. This is something I call digital quotient. What is digital quotient? Some of you actually know this term. It's called digital quotient or EQ in other banks. It measures what percentage of a bank's customer touch points are performed digitally, be it onboarding, be it servicing, be it payments. The higher the DQ, the higher the efficiency, lower the cost, higher the customer loyalty. And that's a proven equation. Currently, we are at 69% DQ on an average across onboarding and a very low 30% across servicing. Now, payments is good, but servicing is 30%. We want to reach 90% in the next financial year. Now, why 90? Because 10% could be physical by choice, elite customer segments, vulnerable segments, banker on wheels interactions. But if we can touch 90 in each of these areas, our cost efficiency will increase, our customer loyalty will increase. So this is a metric that we will continue to track closely and enhance in the months to come. Equitas is traditionally relied, like most other small finance banks, like even smaller private banks, on vendor-driven software. The problem with this approach is one does not control the software or own the IPR, cannot make changes easily, elongates timelines for new developments, and increases cost. Typical margin in software industry, and many of you know this, anywhere from 40 to 70%. Building in-house software, which we own the IPR of, where we can manage change easily and cut costs, is a fundamental tenet of our roadmap. Today, 90% of our applications are vendor-owned and vendor-managed. We want to migrate that to a 60% in-house developed. In other words, 10% in-house to 60% in-house control is a part of our roadmap. This will take us a couple of years to get there, but we are making progress already. We have already developed a large part of our Equitas 2.0 app internally. Our gold loan platform has been built internally within a matter of 6 weeks, and there are other projects in progress. During the rest of this financial year, we will actually go live with an enterprise LOS that we have built, which consolidates all of our LOS platforms into one in-house LOS, which is not something many banks have managed to succeed in doing. We will also launch an in-house development center, a local capability center, sometime in the third quarter of this year in Chennai. I do want to just very briefly touch upon this. Resilience is super important for a customer. And we've had some challenges in the past, but now I'm happy to share that our resilience metrics are equal to the industry. We are at 99.75% on critical applications, which means customers can look forward to a reliable up platform all the time. We are making investments in upgrading our hardware. Almost half of our hardware will be upgraded in the next 3 years. 17% will be upgraded this year, in fact. We are doing this in stages and is part of our already budgeted capex. But what this will result in is providing headroom for growth to support Murli and Jagi's projections of growth. We're not playing catch-up anymore. We are proactively forecasting and adding the hardware in advance so that we can support growth seamlessly. One last point on the slide. We are optimizing our cost by using a mixture of cloud and on-prem solutions. 85% today is hosted on-prem, 15% on cloud, and the mix of this gives us a good level of cost efficiency on our hosting strategy. Very early days on AI. Some of you have questions on AI. One of you was speaking to me earlier today. Very, very early days, because we are still trying to get our fundamentals in place before we move to full adoption of AI. But there are 6 areas we've identified, and this is listed on the slide, where we either have POCs in flight or we are working with vendors to build solutions for us. 2 will go live next month, which is on check clearing and on the collections voice AI. By end of this year, all these 6 should be live. But this is really still just a testing stage. If we get these 6 pilots right, then we look at a larger use next year. Data. We have now pulled together all of our systems across the enterprise into one data layer, an EDW, a data warehouse. This is something banks have struggled with in the past, but fortunately, I think we managed to get this model quite well. All of our data flows today come into EDW. All our reports are generated from there, be it for internal MISs or regulatory purposes. What this gives us is a great deal of agility on managing our information. And just as a flavor, 40 systems producing 1,000 plus reports, of which 800 are daily and automated today. I want to end with this because security, cyber security of our systems, of our data, it is one of the key themes that all banks are concerned about and the regulators are concerned about. This is an area where we are outperforming the market significantly. If you look at the metrics on the right side, in every one of these important metrics, time to detect, time to remediate, our data breaches are 0, in fact. In all of these metrics, we are doing better than the market, which is a testament to our solid cybersecurity design today and to our hosting and architecture defenses. We are also now looking at the DPDP Act, the Data Privacy Act. A couple of you are asking me about this in the morning. We are building the solution in-house as part of our thrust towards building more in-house software, and we expect to be live before the deadline of May next year. So this, in a nutshell, is what we're doing on technology and digital. Overall, our objective is to reduce our operating cost and increase customer loyalty through a tech stack that is equal to the best in the market. With that, I will close my presentation and hand it over to Vasu for his concluding remarks.
Yeah. So we gave you a lot of inputs on what's happening in the bank, who is doing what. At the end of the day, what would that mean to you guys? So what's it that we are likely to end the current year on? We have already given this in the last quarter analyst report. We have already given that investor presentation, just reproducing that. So we expect to end the current financial year. The last quarter, we should have a 1.5% ROA, is what we have been saying for a few quarters now. In fact, we said the last quarter of last financial year, we said we'll end with 1% exit ROA. We slightly exceeded that. I think we did about 1.45% ROA. This year, we expect to end the last quarter at 1.5% ROA. And for the full year, we expect the ROA to be about 1.2%. Yeah. And if what we've been saying through the morning becomes a reality, and I hope it will become a reality, so we expect our advances in a 5-year time frame. We are giving basically a 5-year plan. In a 5-year timeline, we expect our advances to be about 1.2 lakh crores and deposits to be slightly above that at 1.3 lakh crores. Cost to income should be somewhere in the late 50s, driven largely by the leverage that we will be able to achieve of all the investments that has been done in the past and being done today. And the credit cost, we expect it to be, around 1.5%, 1.2, 1.5%. And if we look at the ROA, we expect ROA to be steady at around 1.5%. I mean, this year, as I mentioned, we expect the full year ROA to be around 1.2. From next year onwards, we should expect to achieve an ROA of about 1.5%. If we get a lot of tailwinds on the credit cost, and if the entire credit environment is very positive, we might actually go up to about 1.8%. On the other hand, if something happens in the external markets and, unseen or unknown factors happen and creates a lot of stress on the portfolio at the industry level and at our bank level, even then, we do not expect the ROA to really go below 1%. I mean, subject to some absolutely dramatic stuff happening, minus that, I don't think we should expect our ROA even under a very heavy headwind credit environment to go below 1%, but the upside could potentially be about 1.8%. On an average, if things are reasonably normal, then we should be around the 1.5% ROA level. So that's what we expect over the next 5 years. Yeah. So thank you so much. And I think we are slated for a short 15-minute bio break and tea break. And after that, if you can come back, then we'll be happy to take any questions from you. Thank you.
Yeah, welcome back. We'll start with a Q&A session. So can go ahead with your questions. Maybe, Sundar, if mic is needed, maybe we'll have to. It's there. So our guys are there. In case you want to use the mic, please go ahead.
Hello, hi. Hi, my name is Shubham. I'm from Altruis Investment Management. Thank you for giving this opportunity to meet you all and ask some questions which we are thinking.
We can't hear you.
Okay. Now can you hear me? Yeah, fine. Sir, I have a first question with respect to the lending activity. Given this war is still on, do you see any kind of challenges in the lending activity at this moment?
No, we don't see any kind of challenges. As I said, most of our customers in small business loan and housing or informal and semi-formal segments. So these are all essential services. Even in vehicle finance, we don't see any kind of impact. We just have to wait and see.
See, in vehicle finance is the one which is most likely to be impacted by what's happening, from a broader economy perspective. The fuel prices have, as you know, has gone up recently. That's the segment likely to be affected is vehicle operators. But we are largely, our portfolio consists of small and light commercial vehicles. Our heavy commercial contribution is much less. And even in the heavy commercial, the kind of customers that we fund to are not the large fleet operators where they are having tie-up with corporates. Okay. So when the fuel price goes up and the cost of the fleet operator goes up, his inability to pass on is largely from the corporates. If you have a 1 year, typically it's an annual contract of freight from corporates, and corporates take a lot of time before they adjust their pricing. And during that time, the operators ends up losing. So that really happens when you have a contract with corporates. But light commercial, small commercial are all market load operators. And so they actually are able to adjust the price quicker than what a typical corporate will allow it to be adjusted. And in fact, today when I was coming from Chennai, I was reading in the newspaper that yesterday the Tamil Nadu Lorry Owners Association has taken a decision to increase the freight rate by 25%. So, these are all the ones which are for the market loads. And so there the adjustments are a little bit faster. So we have to see. I mean, there may be some impact, but we don't think there will be a big impact on our vehicle finance.
Okay, that was helpful. And with respect to growth in MFI lending, what sorts of discipline we are maintaining while we are underwriting these loans? Any view would be helpful in that.
I didn't get you. Could you repeat?
My question is with respect to growth in MFI lending and what kind of discipline we are maintaining while we are underwriting those loans.
So as I said, we have additional lanes apart from the MFIN guardrails. We have internal controls like we don't lend to a customer who are in 1+ DPD for a NTB and NTC. Even our existing bank customer, as per MFIN guardrails, it can be 60+ DPD, but we kept an internal norm of 30+ DPD. Apart from that, our microfinance is a fully evolved model, like a digital fully onboarding, biometric eKYC, and everything is digitized. And apart from that, our all this portfolio has been covered under the CGFMU. So it also gives an additional risk protection for us.
And going forward, it will be at 10% of our mix, or it will be increased over the period of time, or we are maintaining that level only?
No, we will be maintaining at around a 10% levels.
Okay, that was helpful. Thank you.
Hi, good morning. This is Deepak Gupta from JM Mutual Fund. Thank you for your presentation today. In your opening remarks, you mentioned about right to win in certain segments in which you operate. Just wanted to understand your thought process on the MSE segment and foraying into credit card and personal loan, given the fact that you've made a conscious choice of reducing your unsecured segment, which is microfinance, and then you're venturing into credit cards and personal loan, where there is long gestation period and long road towards profitability. And on the MSE segment, the asset quality has been a bit dodgy in the last 2 years. So what's the right to win in that category?
So Jaggi will answer on the MSC. On the credit card and PL, it's basically for us, it's a cross-sell product that we have launched it as. And so to that extent, our investments, our expenses are also not very high. It's not the typical credit card big bang launch where we will book huge losses for long period of time before we break even. So we are not going through that route. So it's largely meant for cross-sell and improving the stickiness of our deposit customers. We had to spend some money last year in terms of setting the product up. But this year, even if you assume that we don't do any credit card business at all, totally, let's say, our entire hit to the P&L will be somewhere in the range of 7 to 8 crores. So it's not a big bang approach that we have taken. We have taken a very marginal costed approach and ensuring that it's largely meant for liability customers.
Regarding on the MSC, as I said, it's a relationship-led model. So we primarily source from the liability networks. Almost now we are increasing our contribution to liability branch networks. On the asset quality, if you've seen in due to certain COVID impact, which those are all old loans. From 7.5, we brought it down to 3.4, and there is one bigger account. Otherwise, it would be less than 2%. Our focus on MSC basically to leverage the cross-sell opportunities from the liability side. Okay, so we will be maintaining in the range of between 3 to 4% as far as MSC has been concerned on our overall book, which is currently at the same levels.
My question was that the asset quality in that segment has been a bit dodgy. I think the NPAs in the last quarter was about 3.5% or so in that segment. So are you expecting some kind of recoveries in that segment? And why do you want to venture into the segment where the asset quality is poor?
The asset quality, year back, it was 7.4% in terms of the GNPA, which has been brought down to 3.4. I think we have one big account. If I remove that, it will be less than 2%. But we have been so conservative in our lending approach in MSC. As I said, it's mostly to supplement our cross-sell opportunities for the liabilities. So we will not be going away, but we will be maintaining at the same levels in terms of the portfolio mix with a better asset quality.
I hear you. My second question is on cost-income ratio. I saw your FY31 guidance where you're looking at cost-income ratio to come down at late 50% or so. Do you think structurally this business cannot run at a lower cost-income ratio below 50%, where a lot of larger banks are operating? Or you think structurally this is the best cost-income ratio that you can aspire for?
Yeah, so that's what is the inclusive banking model all about. So there's a cost element associated with being in the inclusive banking segment. And now the question is, what will be my yield? Right now, our yield is around 15% plus, correct? So the question is, what will be our yield going forward? Will our yield drop? And if our yield drops, to what extent the cost income will drop proportionate to that? That's the question. It's not about whether cost income at 50% in the late 50s is good or bad. It's not about that. It's about linking that to the yield. So if we are able to hold the yield anywhere near where we are today, even with the 50 basis points this way or that way, and the cost to income drops from our current 70% to late 50s, I think that can still be a significant benefit from a bottom line perspective. So it's all about yield versus cost. But so long as we are in the business that we are in today, cost is going to be at a certain level. It can't go to the typical 40s kind of stuff. It can't. It just can't. So as I mentioned, even if the other banks want to have 10% of their book coming from this inclusive space, they need to increase their staff strength by 60%. That's the cost that we are incurring. So there's no way that this model can deliver a 40s cost to income. But if we can get it down to the 50s, late 50s also, with not too much of yield drop, I think that's still going to be a good impact from the bottom line.
And sir, lastly, if I may ask this question, there have been a lot of murmurs that you're looking to move on from the company. So if you could give us some sense about how long is your term with the board and what are your plans going forward?
Oh God.
Sorry for being direct, but
No, I thought, I mean, I don't know, if you have some inside information, you should tell me also, so that I'll prepare my CV now. Right? So, there is that one cricket, somebody, I think an Australian player said, that was a moment of brain fade, if you remember. Some of you may recollect. Yes, yes. So I think every human being has allowed one brain fade in their lifetime. I hope so. And I've had mine in 2021. And that's it. Now I have another 5 years to go against my 15-year, which is max allowed by RBI. My term ends in next month, July 26th. My term ends. And now RBI has approved a 3-year from next month till 2029, July. So that approval, I think, came a couple of months back. And so that is July 29. After that, I have 2 more years under that 15-year rule. So God willing, RBI approving, you guys supporting, I should be here to deliver this 5-year, whatever I said, 2031, right? 2031 March. I should retire in 2031 July. So I hope that I'll see you guys in 2031 March or maybe April, May, and tell you that, yes, we have over-delivered on this.
Absolutely, sir. We look forward to it and all the best.
First of all, thank you, Vasu sir and team, for making a very detailed presentation, very helpful. This is Anil Tulsiram from Best Pulse Research Advisory. My first question is on OPEX. I'm not looking for any numerical guidance or anything else, just qualitative comments. If your balance sheet goes 3 times in next 5-7 years, whatever the time, what are the major OPEX items which will grow in line with the balance sheet, and which are the major OPEX items which will grow in less than the balance sheet? So that's the first question.
Structurally, if you see, most of our large structural investments are completed. New products on the liability side, new products on the asset side. Practically, we have everything in place today. Okay. So from a product investment perspective, yes, we will continue to do a marginal increase in investments in all the products, but we are not going to be starting a completely new ground-up product, which will have to have heavy investments and take 3-4 years before it breaks even and all that. So structurally, if you look at it, products may not be a large investment-led factor over the next 3 to 5 years. Branch expansion, we have got about 420 odd branches in liability, about 550, 600 branches on the asset side. And as both Jaggi and Murli both explained, the average deposit per branch or average asset per branch, wherever it is currently, they still have a scope to grow from there to at least 2x to 3x, per branch, because that opportunity exists in the markets where we operate. So branches we will continue to expand, but it may not have to be expanded at a very high speed. So maybe we'll continue to expand, like Murli was saying, 15-20 branches a year in liability, and maybe Jaggi, maybe 40-50 branches a year, which is something that they may look at, but it will not be something very heavy from an investment perspective. What else? IT. Now IT, my ED is sitting right next to me. They guzzle money. They seriously guzzle money, and after a point, you have no idea. They will always make a presentation on ROI. Okay, they'll say 3-year ROI, 4-year ROI, but the third year never comes actually. Before the third year comes, there'll be one more investment required. Okay, so IT is definitely a guzzler, and it's a must. You can't help it also. But in IT also, most of our large requirements are already in place. And what Balaji explained in terms of trying to internalize our developments, app developments from 10% of in-house sourced app to 60% over the next 3 to 4 years. Actually, that may call for some investment in the beginning, but it will actually be a big savings later on because we pay about 20 to 22% of AMC to the vendors. That's a huge amount of money. For example, our IBM app, we spent about 30 crores to develop that, which is live now. If we had gone to a vendor and paid, let's say, the same amount of money to a vendor, every year I'll be paying him about 8 crores of AMC. Today, I don't have to pay that at all. I did invest 30 crore, but I don't have to pay 8 crores a year. Whereas with a vendor, I would still have paid that 30, or if not 30, maybe 25, but I'll pay him 7 crores of annual maintenance charges. So over time, there will be a lot of benefit from internalizing the apps compared to outsourcing it. So the short answer, after long explanation, short answer to your question would be that from 45,000 crore of assets and deposits to 1.2, 1.3 lakh crore over the next 5 years, which is about 2.5 times growth, let's say, cost, which will be the drive cost, which will actually grow 2.5 times. I'm not able to really, identify that. I don't think any of the cost should really go by 2.5 times for the same period of time. Cost will increase, but I believe that if advances and business grows by 20 to 25%, cost should grow between 15 to 17%. That's where we believe.
Got it. And the second question is on the customer profile in the asset yield. Again, I'm not looking for any numerical guidance, just trying to understand your thought process and strategy. You said as the cost of funds decline, you will look for better customers. So how exactly you will balance the yields, the ROAs and everything? What will be our thinking process when we say, okay, currently I'm serving a customer with 15% yield, now my cost of funds decline, I will serve 13%. So what's going to be the thought process for the various products? That's the second question.
Okay, see, whatever products we lend and whatever be the rates we are lending and whatever be the yield on the business and cost of funds, the ROA is something that we have discussed. We have mentioned, we have made a mention of the ROA in a medium term of 3 to 5 year timeline. What we are saying is that we should be able to deliver a 1.5% ROA on a steady state basis with a potential upside of 1.8 and a potential downside of 1% in case something absolutely dramatic changes in the market. But that's a range that we should be able to maintain and deliver around that 1.5% on a steady state. So any changes we make in products or any segment of customer that we start doing at the little bit of a formal segment, it will still be aligned with this kind of a return ratio that we will have to deliver at the end of the day.
Sir, and the last question is on the credit cost. In the last 15 years, for all the products, our underwriting has been simply superb, whether it is SBL, vehicle finance, microfinance. But for the last 2 years, FY24 and FY25, we have some very high credit cost in microfinance. So what exactly went wrong? What did we miss and what did we learn? So that's the last question from my side.
See, microfinance, last 2 years, our credit cost has been in high double digit. Which is typically supposed to be 3 to 4% normally. And I think that's now known to everybody. The entire industry went up like a balloon in 2021 to 24. Immediately after COVID, when the demand surged after COVID, the entire microfinance really grew very strongly. From 3.5 lakh crore business, it became 4.6 lakh crore business by March 24. And that scale up by the industry uh, looks in hindsight to be done at the cost of over leveraging the borrowers. And that's what really unraveled in 24, after 24 March, that over leveraging really came back to hit the entire industry. And so everybody lost, and we also ended up losing. But what we did during that time was that we started reducing our MFI loan book during that time. And so as a percentage, it looks higher because our microfinance book actually was coming down. And that is how we were able to reduce it to 10% today. It was 20% when the crisis hit us. And at the end of the crisis, when the crisis is behind us today, we have reduced it to 10%. So during this time, we actually reduced. And that's why percentage-wise, it also appears to be on the higher side. But the learnings is basically that you got to be careful in MFI. But the reality is that microfinance is not a single entity business. It's a industry-wide business. Okay. If, for example, if when I do a car loan or I do a home loan and I do it correctly and everyone else does it badly, my portfolio won't be affected. I will still get all my money back so long as I have done a good job on credit underwriting. But in MFI, it's not like that. I may be doing it very correctly also, but if others don't do it properly, I'll also lose as much as everybody will lose. See, it's that kind of a business. So beyond a point, you can't help, and that's the only way to manage the risk is keep it at a lower level.
Mr. Vasudevan, thank you for the presentations, and I think it seems like we are setting the ground for the long term, in various measures and on all sides of the business. But I think I had a structural question. As we are targeting this 20% kind of growth, our cross-cyclical ROEs have been quite depressed for various reasons, because of the investments we are making, because of unseen factors that come and hit us. But how do we manage a 20% kind of growth when we are not generating enough profitability at the core, at least up to this point? I understand there is promise, but we have not been able to. So are there serious dilutions that we are anticipating? Mathematically, how are we going to do 20% growth when our ROEs have been 10% or below?
See, at 1.5% ROA that we are committing to, the ROE should be in the range of 15%. And a 15% ROE should be able to comfortably support a 20% growth.
Yes, but will that be an ongoing cross-cyclical average 1.5% ROE that we are looking at?
Yeah, that's what we have mentioned, that in good times it should go up maybe to 1.8 or around that area. If there's unexpected pressures, mainly on microfinance, unexpected mainly because we have had the demonetization, which was a big event. Then we had Corona, and then we had the MFI crisis last 2 years. But the non-MFI book has never really faltered. Okay, it's the MFI book, every time it has faltered. So when we say that if there's a heavy, headwind on quality, credit quality, we'll have a lower ROA, we are basically talking of MFI. In spite of whatever happens, our rest of the book has generally performed very well over a long period of time. Okay, so subject to MFI going up and down because of external factors, we are still predicting a steady state of 1.5 over a period of time. Maybe 1, maybe 1.8, but 1.5 on an average. And 1.5 on an average should be comfortable from a 20% growth.
Yeah, I understand. Last time we met a couple of years back, we had also talked about how the transition to universal bank will again help this ROA and ROE, particularly ROE because our leverage capability goes up, structural cost of funds goes down. Now that also has been a challenge. So how are we positioned on that? If you can elaborate a little bit more. Thanks.
On what? I didn't get you.
On universal banking license, which is a path towards enhancing our structural ROEs, as we had spoken about.
Right. So let's talk of universal bank. What will be the benefit in case we get that at some point in time? One is that the capital adequacy goes down, requirement goes down. from 15 to 9, but it's not 9 if you have to add the market and other cyclical buffer and all that, which is required for the universal bank, not required for us. So typically they have to have about 11%. 11 to 11 and a half. We need 15. So you're talking of a 3% difference, 3.5% difference. So I can potentially leverage another 1 to 1.5 times if I'm also allowed to have a 11.5% requirement. So ROE will improve somewhere in the range of 2 to 2.5%. ROE should improve if we get a universal bank license. That's one factor. Second is that from a deposit perspective, the comfort will definitely go up if the name changes. And over time, that comfort can be converted into some kind of a reduction in the interest rate that we offer. Okay, that will again help from a cost of funds perspective. So basically, these are the benefits from a conversion into universal bank. Actually, there's no other benefit, really no other benefit. And people keep asking me that you will have to do a heavy investment if you become a universal bank. The reality is no. All the investments that we have done is exactly what is required for universal bank also. There is no difference from a regulatory perspective between an SOB and a universal bank in terms of compliance, in terms of technology, in terms of controls, in terms of anything. There is really no difference at all. So if we become a universal bank, I am not required to invest heavily in any new area that is required as a universal bank. So there are just these two benefits. So it's important. These two benefits are important, and if it comes, it will definitely help us. But if it doesn't come, they're still manageable.
And where are we in that journey today, and where is it getting stuck?
Okay. So the RBI's guidelines are there in terms of conversion to universal bank. So we have gone through the guidelines. We believe that technically we are in compliance with those guidelines. So we are in dialogue with RBI, and so we are kind of just checking out from different departments of RBI. What do they feel about it? I mean, we feel that we are qualified. We feel that we are eligible, but we are also trying to figure out what they feel about it. And once we get a reasonably, clear confirmation from different departments of RBI that they also feel comfortable with us, then we'll end up applying. So if you ask me a timeline for that, I would say maybe a couple of quarters. So it will take us a couple of quarters, and by then, if we get a reasonable indication, then we'll end up applying.
Hi, sir. Param here from Investec. So thanks for the presentation. So first question again on your right to win, say over a longer term time frame. So you in your slide you mentioned your say landed cost of funds, including CRR, SLR costs is 8.2%, which is at par with say a AA rated NBFC. Now those NBFCs have already largely solved for operating leverage. Like you mentioned, you have SSMs who are looking at you on a daily basis. The compliance cost is lower. So over a longer term time frame, if we are to build scale, how exactly are we going to work around this problem of cost of fund? Because CASA, the elite book has been a bit of a challenge over the last say year or so. Yeah, that's my first.
See, cost of funds is a byproduct of product mix. The quantum of current account, savings account, retail TD and bulk TD. These are the four components, because taking CRR, SLR, whatever is the base is going to be same. So there are three things that is happening. One is enhanced focused on current account. That is why we are making our entire payment structure correct, getting QR right, getting POS right, getting soundbox right. We have done all those three things. Now we are also digitizing current account. So which means current account should be at least 10 to 12% of the book. If you see any established bigger entities, they are in the range of 10 to 15% of the total book is current account. Then what happens is your leveraging of cost shoots up, because zero cost, 10%. Then second thing what happens, SA we are already in a laddered route. So we are on a mass affluent channel. Once digital goes up, we will be acquiring mass only through digital channel. So that will bring in low cost 2.5% SA or 3% SA at the second part. So that is going to be a digital drive which is going to bring that. Third is on time deposit. See, time deposit, initially we were closer to 1.3, 1.4, that is 140 bips difference. Today we are at 100 bips syndrome. So as we said, increasingly we are looking at moving it in line with whatever regulator does. So TD is a market driven. CA mixture needs to go up to bring the CASA percentage down. And in SA, lower transacting account, we need to acquire through digital. So we are focusing on digital as a key channel to acquire, and current account based through payments and transaction. That will only, and this will also help us to reduce, say, we have given in last presentation, over a period of 3 to 4 years, how do we reduce close to 90 to 100 bips? Is the journey all about.
Yes, sir. Thank you, Murli. Second question, sir. So when we speak to some of the larger banks, everyone is trying to position themselves as an SME bank today. I mean, I don't know if it is competition that has happened. Retail, we can understand the PSUs are very aggressive. Corporate loan growth is not there. Even some of the larger private banks are saying we are an SME bank now. So, I mean, you have seen multiple cycles in the past. Where exactly are we in this cycle? Because we have seen for the last 4-5+ years, very strong growth in SME. I mean, of course, there are various tiers within SME, but there has been very strong growth throughout the industry. So where are we?
We are not an SME bank at all. Right. We are not an SME bank at all. I'll just give you an example of a conversation that I had with Kamakoti, who was earlier the MD of City Union Bank. So we're just discussing on something or the other. And typically CUB is generally called as a SME focused bank, right? Do you know their average ticket size? Sorry? Okay, four times of that. Okay, he mentioned that their average ticket size is 2 crores. My average ticket size is 8-9 lakhs. So we are not in any way a bank you can call us a SME bank. Okay, we are really on the extremely granular retail lending bank. That's where we are. So if people are gravitating more towards SME lending as a scope for growth and profitability, that might lead to more competition in that space probably. But we are not in that space. We are substantially at a different level.
Yeah. So, but at the same time, I mean, this is the segment where you've seen a lot of NBFCs have also drawn capital. You are 100% aware there are a lot of smaller entities who want to get into business loans, secured products. A lot of the SFBs are saying we want to transition from unsecured to secured. You can see that happening, right? So, how crowded is that, or is it we are just in the early phases of that?
Yes, yes. In this space where we operate, generally we do see a lot of NBFCs operating in that space, that's for sure. And they will compete, they will grow, and surely they will also be able to grow at a fairly good pace, I'm assuming. But if you see my presentation, I mentioned that 84 lakh is the unmet credit demand. And I'm saying that even if half of that, which is like 40 lakh crores, is left for the NBFCs to be serviced, that still leaves 40 lakh crores for the SFBs to service. And if we grow at 20%, we'll still take 30 years to service that 40 lakhs. And I'm leaving an entire 40 lakh crores for the NBFCs, okay, which is not going to happen. And I'll also give you an example of how difficult this whole financial inclusion space is. I mean, I've given a lot of different dimensions of how to measure the difficulties I've given in my presentation. I'll give you one more, okay. There's a person called Deepak Parekh. I think you might have heard of him, right? Okay. So he had this idea in the late 80s to start a housing finance company. So he called it as HDFC Limited, okay. But he positioned that for people like you and me. Then he said, what about people like your driver and my driver? Then he said, let me also start another company. What was that called? Group Finance or Graph Finance, whatever, Graph Finance. He started that company also parallel to HDFC Limited. In the next 35 years or whatever number of years, HDFC Limited went on to become a 4 lakh crore company. And it was so good that finally he decided to swallow it internally. Right. Group Finance, in the same period of time, started by the same promoter, and I'm assuming that the same level of management capability, everything should have been there. In a similar time period, was at a level of dash crores when it was sold. What was the dash? Yeah, 17,000-18,000 crores. That's all it was. So a company which is formal sector NBFC, housing finance, was 4 lakh crores And a similar timeline started company in the affordable space is 18,000 crores. And that 18,000 also, they didn't feel it was good enough. They were happy to give it off to somebody else. Right. I mean, I'm just saying that these are all kind of indicators of the level of challenge in building a monoline, company in the informal lending space, monoline company, right? Now, there are a lot of NBFCs operating in this space, whether it is affordable housing or whether it is the LAP, SME LAP lending. There are a lot of NBFCs operating, and they are typically our competitors. Genuinely, they are our competitors, right? How much will they be able to scale up, and how much will they really become a threat to us and all that? The reality is that I don't think they will ever be a threat for two reasons. One is that their ability to scale beyond a level, 50,000 crore, 1 lakh crore, 2 lakh crore, that I think historically nobody has done it. So that's also always going to be a little bit of a challenge. And second is, even if they do scale up, the size of the demand is so high that it really never should affect us.
Thank you so much.
Sir, this is Rakin Shah from IFL. I have three questions. First one's on liability, so Mulli to you. We spoke about the productivity of the existing branches is already low, and we clearly understand the problem that you can't cross-sell liability to your asset customer base because of the nature of that. But despite the urban metro presences that we have, the productivity is poor. What was the reason why the productivity is poor, and what gives you confidence that it improves? Because when I speak to some other south-based mid-sized banks trying to do that in the other urban metro parts of the India, the problem is same, right? So for instance, in Andheri, one of the bank would say that my Andheri branch only yields 50 crore of CASA, so which is not very meaningful enough. So what gives you that confidence? What was the problem, and how can that change? And the second, if you could also just give a split of your liability between the liability branches and the asset branches, just to get a sense, if at all we are getting what kind of liabilities from asset customer. And the third part here is, why not open a bit more branches in the other parts of urban and metro, where we need not open only 1 or 2 branches in each. I understand it has to be a few clustered to get reasonable amount of it, but why not make those investments and get more liabilities?
As shown in the slide, our present per branch average is 108 crores total deposits. And if you segregate, we segregate branches based on categorization. We say A plus, A, B. We don't go by metro, semi-urban, urban and all. So A plus category are those set of branches which we have 200 crore as a base. We have 35 branches which is moved up towards A plus in last 2 years. A, we have close to 103 branches, which is A means 125 to 150 crores. Now, first step, what I say is our catchments, as I said, 30% of the branches in metros is contributing to close to 60% of the book. A category branches in metro have the ability in next 2 years and headroom to become A plus. Okay. So strengthen that, what we need to do, we need to have a resource-led strategy, which means relationship management has to be strong on one side and very strong UI UX on mobile app. This too has come in. And third important part is range of products. Today, 2 years back, we never had the range of products for investor, saver, trader. Today, I have the entire range of products. So resource-led approach, existing branches in metro and urban, 100 to become A+, that is 200 to march towards that. This is the first part. Second part you asked is semi-urban and rural. See, semi-urban and rural, we started gold loan 2 years back. Now, these branches are feeding gold loans in a big time. And second thing, in these markets, this is a limited opportunity. You can get CASA, but you can keep on doing TD as well as lower length of institution business like panchayat, task account. So we have started moving in those branches through that approach. But this is not going to give you a significant upside in terms of, so your money has to come from, if you know, out of 19,000 pin codes, actually close to 2,200 pin codes represent India's 28 to 30% of the deposit base. In that 2,200 pin codes, we are there at 1,100, 1,200 pin code. So which means upside room in terms of opportunity, upside room in terms of branch migrating to the next level. And D&E, you need to continue what you have opened. And through range of products and TD, we will continue to grow those books in those semi-urban and rural. Now, third point, I didn't get what you asked.
I mean, if you could just explain why was the productivity low of the branches where you see the opportunity, and just by having a better tech and app, do you think that it suffices for you to improve that productivity?
That's a good point. That's a good point. See, every branch takes normally in a break-even sense, okay, 24 to 36 months to break even. To break even a branch, it depends on multiple cost parameters. Okay, when you start a branch, you go sales high, relationship management low. Actually, like you said, Andheri, you met some a competition bank, they said 50 crore, they would have also gone. So now we are relationship high and our propositions have changed. Earlier we used to acquire, even in a place like Andheri, a mass account. Today we are not. What you sell in shelf decides what's the quality of customers that is coming in. For last 6 months, that's why if you see at the back end, clearly mass on digital and mass affluent on right side. Today, through relationship management approach and family banking approach, we are getting into that aspect to get the productivity right. See, productivity is not number of accounts or number of accounts maintaining A and B. It's the quality of customers which we are bringing in. So today it's a spread within the customer of quality, and depth in terms of family and PH is the drive. So you will see an upswing there. There is a conceptual difference.
And why not go to few more other pin codes? If you are at 1100, 50% of the pin codes where you think there is more opportunity. So why not make some more investments and get deeper into those pin codes?
See, we will do 15, 20 branches. I said today we are going to be heavy on resource-led approach, relationship management, quality of customers. I have already in Andheri, assume I have 2 branches, headroom available for say another 400 crores. Putting a third branch is only going to self-compete ourselves. So there is no point in actually adding 1 or 2. Either you have to be very clear, I will have a resource-led strategy to get the relationship right and grow the RV, and use digital to get accounts and then deepen that. So we are taking the first route, use digital to get accounts, use relationship management to get quality and value. So branches plays a peripheral, and it's a very expensive game. I think it's chicken and egg story. It's not like adding 100 branches also in India is going to make any difference unless I get the proposition and quality right. So we are focused today on that top niche of customers, mass, affluent and HNI, and only focused on getting those accounts to get the productivity in terms of value right.
So second question is to Vasu sir. In your presentation, of course, you've outlined about 20-25% growth ambition, CAGR basis. 2 things in that, right? So the first one, credit card PL becoming about 5%. And even within your existing businesses, you are trying to move from affluent to mass affluent category, right? So the banks currently are not present in semi-formal, informal. But I'm guessing in your growth forecast, you are assuming that as you move up, there will be more opportunity. But in that mass affluent formal segment, the banks and other larger players are also present. So that's one part, right? So that's the competition, and how do you think of fields in that particular, because I'm guessing it's included in your growth. The second part is credit card P&L. Of course, you mentioned that it's not a big bang strategy. And it's a cross-sell to liability customers, right? So liability customers today come to you for rates. But why will they come for a credit card proposition wherein, the larger banks or other banks have meaningful better rewards to offer, other partnership tie-ups? And we have seen enough examples of, the smaller banks trying to make inroads into credit card, never making that. So again, that's baked into your growth assumption. So on these 2 specific points, how do you think about it?
I think the credit card I have already mentioned, it's not a big bang approach. So we have not put in huge amount of money on that, and we don't need a huge scale to break even or make profit. We don't. It's a very small level of investments, and basically the entire tech has been set up last year, and this year we will be trying to scale it up. And principally we will continue to focus on existing clients to sell credit cards. Why would they buy a credit card from me? Because they have bought a savings account from me. And so there's some relationship at the ground level between the person and us. And our credit cards are pretty competitive in terms of offers and benefits. They're quite competitive. So customers should, and we are hoping they will find it interesting enough to take a card from us. And if they do that, then obviously it gets linked to the account for payments, and so the account itself becomes more active. So that cycle that we are working on, and that's the purpose of the entire product itself. As far as the other one is concerned, yes. So as our landed cost of money comes down over the next 3 years and 4 years, which is what I have mentioned in my presentation, that will enable us to move up the value chain of the borrowers to the lower end of the formal segment. When I move into the lower end of the formal segment, naturally the competition will be higher than in the semi-formal segment, and to that extent the rates will be at a lower level, but that should be supported by my landed cost of money coming down. So it will be directly proportional to that. So whatever is the reduction I am seeing here, if I am able to use that reduction and competitively service some part of the formal segment, some lower part of the formal segment, then we'll get into that. So it's something that we'll have to be doing it on a very measured basis as we go by, and it will be linked to my cost of funds coming down.
All right, sir. And last questions for Mr. Balaji on the tech. Firstly, if you could just talk about, the changes that we are making on the tech, what does it mean in terms of your overall incremental OpEx from the current levels, in whichever way you can guide? And second, one chart which you showed in your presentation was pretty interesting, that digital line chart of the PSU, private banks, Equitas. Found it surprising that PSU banks digital is superior to private, that particular line, and you have almost closed the gap versus private PSU. So what's going inside that chart? I mean, it was quite surprising to me.
On your first question, see, there are two main drivers in tech cost, the hardware cost and then the software application cost. On the hardware cost, we are pacing out our upgrades over a 3-year period. And our strategy is not to go beyond what we've agreed to be the OpEx and CapEx right now. So we are staying within the annual CapEx. You will not see a spike because of the upgrades, but we're planning it out in such a way that the most essential upgrades are happening this year. Where we need to upgrade next year to support business volume will happen next year, so we paced it out. I don't expect any blip on the CapEx because of the way we paced it out. We've also used cloud very efficiently. We're using elastic cloud, as we call it. So we don't pay for what we don't use. So that's making it quite cost efficient with no CapEx implications. The second question is really spot. Okay, on the application side, if we drive to more in-house development, like Vasu said, he spoke about the AMC. It's not just the AMC. The AMC is absolutely a saving. To the example he gave, if I pay 8 crores AMC on a 30 crore product, into 10 years, I'm paying 2.5 times or more the cost of the product in AMC. I save that. But even the development cost is 50 to 60% of what it will cost to buy it from a vendor. So those savings will also allow us to self-upgrade. We have to utilize the savings from that to become more modern on our hardware as well. That's how we're playing out the budgets. Your second question is quite easily answered, actually. I looked at the same question struck me. Exactly what you asked struck me when I looked at the benchmarking. And Shamu, who develops benchmarking, is here. Public sector banks had some advantages because of areas like TDS payment or tax remittance, where they had more functionalities to start with. So the benchmarking model scores them on the functionalities they have. And some banks like SBI, actually was, with the YONO app, were quite up the curve in bringing all products and all external services into one app. So that skewed the score somewhat. But if you look at core functionalities, private and public sector banks are not that different right now. The point I wanted to make in the graph was we certainly had some room to catch up with the others. And now we have more or less caught up. And by end of this year, we'll be fully catching up with the banks, whether the private or public sector, the best banks in the market. That is the core point of the slide.
And sir, on this, just a clarification. So if you could just quantify in last 1 or 2 years, what was your total tech expense in absolute crore or as a percentage of OpEx, and how that changes in next 2-3 years, just so that we get a sense of, where it's moving.
The CapEx is about 159 crores. The OpEx is about 211 crores. We're going to keep that constant for the next 2 years to upgrade all of our facilities. But from the third year onwards, which is FY 28-29, you will start seeing a reduction of, I would say, roughly about 25% in application cost once our development centers start, producing 60% of our software. So flat for 2 years and down about 20% on the app cost after that, flat on hardware cost after that.
Thank you, sir.
Hi, sir. Ashlesh here from Kotak Securities. Three questions from my side. Firstly, again on the liabilities piece. We see that there has been a lot of effort put behind the liabilities piece in the last few years. That has helped you mobilize a lot of deposits and will possibly help you gain more as you scale up. But if I just look at the cost of SAR deposits on a standalone basis and the cost of term deposits on a standalone basis, from 2018-19 onwards and where we are in 2026, it has actually not moved. And it possibly has worsened also a little bit. How do you think about the reason for that and if that can improve going forward? That is one. Second one is on the operating cost structure. Vasu sir, you have mentioned quite a few times in the past that all processes, including collections as well as sourcing, have been done in-house. Would you consider selectively moving some of it externally if that can benefit you on OpEx structure. And lastly, if you can also shed some color on how you spend your time, because you have built quite a comprehensive management team around you with a fairly high vintage already. If you can shed some light on how you spend your time, because you have built a comprehensive team around you already.
So thanks. For the first one, I take it. Like you rightly said, let's see. Last year, as we exited, our cost of funds for SA alone was 5. Year before last, it was 6.1. Before that, it was 6.3. So SA is gradually coming down for 3 reasons. One is because of our laddering system in terms of pricing. 0 to 1, 1 to 3, 3 to 5. An actual kicker of 7% or 6% starts only after 5 lakhs. So up to 0 to 1 lakh, 2.5% I am on par or better or on par with any private banks or public sector bank. 1 to 3, we are 100 basis point. So which means even if you keep 5 lakhs, the first 1 lakh is going to give me the same. So cost of SA is coming down. Cost of TD, we are not benchmarking, should I be 25 basis point lower, or we are saying what is the reference point and what is the differential and how am I bringing down the differential over a period of time. So 3 years back, the differential between us and the private bank competition used to be 120, 130 basis point. Last year, it came down up to 85 basis point. Today, we are back to 100 basis point. So SA is the differential between what we have it in laddered system and benchmarking it, and gradually. So the 5 presently we have slightly tweaked it, will look like another 13 basis point going up. So even with going up 5.13, we are on par with what we will have given the average SA rate last year. So SA, there is no issue at all. TD is the supply demand. BTD is the one which is on a supply demand equation, which is needed because BTD is close to, we have 10,000, that is close to 20% of the book is there. So it's on supply demand equation. And when we are not able to mobilize retail only, we are going to go there. And TD will continue to maintain the differential like this at this point of time. So SA 5.13, 5.15 will be the range in which it will move for another 1 year. TD, the differential, if there is an opportunity, we will bring it down or we will keep the 100 basis point, right? BTD, we can be prudent by taking it at the non-demand time. These are the 3 sets of costing which we are planning.
The second one was on OpEx, how much we can outsource compared to what we are doing currently. The sourcing, we may not really outsource too much. I mean, there will be always a marginal change over time in terms of DSA sourcing and all that, but it will not significantly change because, most of our businesses are sourced internally through referrals from existing clients and all that. So that will still contribute a large part of our business. And we would prefer it that way because we need to understand these customers thoroughly before we can take a call to lend to them. But on collections, we may not outsource collections. I don't think we'll ever outsource collection actually. But we have already put up the telecall center. Jaggi mentioned that about maybe 3 years or 4 years back, we have set that up. And they are doing about 65% of all check bounces are collected by the telecalling team without the field team having to visit the clients. Am I right?
35% we are collecting through the telecalling setup. And the productivity will be something like a 3x, where the allocation in the field will be something like 80 to 85 cases. The telecaller, the allocation is 250 cases. That will further go to, as we said, within a year or two, go to 60%. We also piloting through AI. We are facing we are just doing a piloting on the regional languages, and we had to get the confidence in terms of the resolutions. Once it goes through, then the productivity will be not even a 3x. It might be even 10x kind of stuff.
Yeah, so today the field staff, we allocate approximately 60 accounts per staff. The telecalling staff, we allocate around 200 to 250 accounts. Okay, but AI bot, we actually tried it out for some time on a test basis. And so we went live with Hindi. because Hindi was the only thing which was working reasonably well. Other languages just was not taking off at all. So we tried it with Hindi in a few Hindi speaking states, and the allocation per bot was something like 2,000 accounts. A bot could handle about 2,000 accounts comfortably. But only Hindi. The other languages we are still experimenting. The vendor has to really come back with much better refinements on the other language. So our efficiency in collection is something that will largely revolve around setting up more telecalling centers, but also trying to get AI to work, AI bots to work in an efficient manner. So that is where the cost reduction should come in on the collection side. But on the sourcing side, we will continue to expand on DSAs and all that because they give some amount of flexibility. But by and large, I think we'll still be internally sourcing.
And also in addition to that, since even on the growth, what we have talked about other verticals like affordable housing, we are going to place up in the small business loans. So the entire functional teams, we don't have to set up a standalone teams. It can be utilized with the existing structure itself, which we can able to optimize our cost.
And the last point of where I spend my time on, before the MFI crisis, that is up to March 24, or maybe you can say June 24, up to that, I used to spend about 90% of my time on compliance and audit and risk and all that. 90%, 10% on business, because business was doing quite well on both sides of the balance sheet. But once the MFI crisis hit us, actually that amount of time I started spending on the business had to go up. It did go up. But then around that similar timeline, Balaji joined us. And so he has actually been able to handle most of the operations, IT, and interface with audit and all that. He was able to handle. So to that extent, I was able to reduce my time on that. And I think if I'm trying, as you asked the question, I was trying to figure out on a daily basis what am I actually doing. Okay. I think I'm now a little bit more balanced. Maybe half my time on business, half my time on compliance and risk.
Thank you, sir. Considering the time constraint, maybe this should be a last question. With this, we can end this Q&A session. You can take this.
Hello, sir. This is Shivan from Humiviction Investment Advisors. One question on your guidance of the ROA. You said it can be between 1 to 1.8. And the major risk to that is that for the average that you have given is that microfinance is the major risk. Any upheaval out there can get it to 1%. But sir, the book that we are building in microfinance, the newer one, is completely CGFMU'd. So you've got the full insurance there. So then how can there be any hit on account of that? So that was something that I wanted to understand.
Actually, good question. Even we don't know. Actually, CGFMU, we have no experience. Now, currently, I think what percentage is covered?
72 as on 31st March.
So as of March, 72% of our MFI book is covered under CGFMU. We haven't made a single claim so far. I think at the industry level, to the extent that I have seen, Suryodaya and now IDFC First Bank have made a claim and received some money under CGFMU. We have never made a claim so far. We really don't know much about that. Okay. And these data points that we are sharing or the estimates that we are sharing is assuming CGFMU not being part of our picture. Okay. So if that comes in and if actually we are able to get a significant part of any potential losses in the future covered and repaid by CGFMU, to that extent it might actually help in terms of improving the bottom line. But right now, at this point, we don't have any experience, so we are keeping it out of our entire calculation for the moment.
Okay. So one more question. This was on the risks part that you had covered in your SWOT analysis. So with the advent of technology, with AI being used and the technology, moving at breakneck speed, do you all consider a non-brick and mortar, a completely digital model like a fintech being a very big risk to the way underwriting has been done for the secured book the templatization that you all have, how do you all perceive this risk?
So if I think about that in the night, I'm gone. um, yeah, I mean, so Balaji in his presentation talked of 5 initiatives with AI, which we are currently working on. I think 2 of them pilots are going on, 3 of them will start shortly. But I heard him mention that all the 5 should be completely live by end of this year. So there's some amount of effort that we are also doing in terms of seeing how to use AI to improve productivity or improve speed, cut cost, and things like that. And the next question is, how do we use it for underwriting and quality of underwriting, improve underwriting, and all that? Again, Balaji has had a dialogue with Sriman, and they're both working together on that. In terms of how much can we centralize decision making because of technology benefits and improve the consistency and quality of underwriting along with the cost reduction. If some of you might have heard, I don't know, L&T Finance MD was on CNBC some time back, and to a question asked by the anchor, he said that they have been using AI for underwriting for about a year plus now, and the check bouncing ratio for those products, which used to be around 23-24% earlier, after that AI underwriting was introduced, over the next 6 to 12 months, they have seen the check bouncing ratio coming down to as much as 14 to 15%. That's what he mentioned. I mean, I can refer it because it's public, right? So that's what he mentioned. So maybe there's a lot of potential. We don't know. Also, the kind of customer that they lend to, whether that is amenable to AI underwriting, maybe our customer segment is not amenable. All these are finer points. We are also wanting to find out. We are also working on it. Between Sriman and Balaji, there's some amount of dialogue that's already started. So they will work on it, and we'll have to see how much we can use it in our setup.
Thank you. Thank you very much.
Okay, so there's only one question that you guys didn't ask me. What keeps me awake at night? You didn't ask me, but I'm going to answer that question for myself. You guys. Thank you.
So that's the end of Q&A session. Thank you, participants. Yeah.
We are giving a thanks speech by Sundar, so please, for a minute.
Good afternoon, ladies and gentlemen. As we come to the close of Investor Day Analyst Meet today, so it's a privilege for me to give a vote of thanks. On behalf of Equitas Small Finance Bank, I extend our sincere gratitude to all of the investors, analysts, and other stakeholders. You made this event really a successful one. I would like to express our heartfelt thanks to our MD, Mr. P.N. Vasudevan, and also the leadership team for sharing their perspective with respect to the strategic vision and the growth going forward. We are also grateful for this thoughtful Q&A session. This was really insightful. And we also thank the organizers. Without them, this event would not have been possible. And this was a real hit, I should say. And going forward, there's a kiosk session that is there. So where the business heads will be available. So you can have an interactive session with them. So you will get the deep understanding about the product process and also about the customer journey and also about LOS. You can have a one-on-one session with the business leaders. So yeah, that's thank you all, and thank you for this participation.
Yes. See, we have a set of people. If you want to understand about gold loan, we have Prasanna. Anything about mobile banking app, Shanmugam is there. Anything about product and Artha and savings account, Devan is there. And then we have Herald.
On the asset side, for a small business loan, we have Herald, a business side for SBL, And on the vehicle finance, we have Mr. David. On the microfinance, we have Paramasivam. On the affordable housing, we have Mr. Sriram Joshi. And on the MSc, we have Satish Shankar. And even for the collections, you need to understand how the way we work on these segments. We have Abhishek Rana, who is heading the collections for the bank. So these are the people where you can have an interaction during this, after your lunch.
Thank you. Thank you.